So the next speaker of the session is Dr. Xiaolei Xie. I know him since 2015 when we were both a PhD student at University of Copenhagen in Denmark. And now he is working at London Stock Exchange Group in London. And he's going to talk about a short introduction to interest rate models and their applications. Dr. Xie, please go ahead.
All right, so good morning, everybody. Thank you for coming to my talk. So in the next 30 minutes or so, I'd like to share with you some of the work at London Stock Exchange on interest rate models from the perspective of mathematical finance. But firstly, please allow me to make an introduction about myself. So I am a quantitative analyst at London Stock Exchange, but I don't exactly trade stocks for a living. Instead, I work on the mathematical tools that enable people to do so. And indeed, the tools that we provide at this company extend beyond stocks. To name a few, we cover many kinds of bonds, futures, and options. And in case you wonder, let me tell you briefly about these financial contracts. So first of all, bonds. A bond is essentially a glorified term for I owe you. Buying a bond is effectively lending money to the issuer of the bond. It obliges bond issuer to pay its holder specified amounts of money on specified dates. And as with all other forms of lending money, it obliges the issuer to pay interest as well. A future in this context is not a time, but a financial contract. It is an agreement whereby the issuer of the future agrees to deliver a specified amount of goods, for example, oil, gold, or wheat, to the buyer of the future on a specified date in the future. The price of the future is a price that both parties agree upon for the delivery of the goods. This price, however, is not paid on the day when the contract is settled, but rather on the day when the goods are delivered, which is probably fair. And finally, an option is another financial contract that gives the holder the right, but not the obligation, to buy or sell a product at a specified price on a specified date. For example, a call option on the British pound to Chinese yuan exchange rate that has strike price, say 9.3, and that expires on the 15th of May, gives its holder the right to buy 1 unit of British pound with 9.3 Chinese yuan on the 15th of May. If, however, on the 15th of May, the exchange rate is lower than 9.3, the holder of this option obviously won't use this option, but will simply let the option expire. As you can imagine, the first question that one will ask about a financial contract is, how much is it worth? In other words, at what price is a contract fair to both parties? But then what exactly does it mean to be fair? In the world of finance, fair means neither party of the contract can make money without taking any risk. In financial terminology, people say no arbitrage exists when the price is fair. And finding the fair price of a financial contract is what we refer to as risk-neutral pricing. And interest rate models are essential in this effort. So in the rest of the time, I'm going to touch upon the following topics. So firstly, I would like to tell you a bit more about risk-neutral pricing. After that, I will tell you more about bonds and their cash flows, which is another way of saying the bond paying its holder the specified amount of money on specified dates. And then we will go on to talk about the Vasi check and the whole wide short rate models with respect to their application in risk-neutral pricing. And then I will talk about bond options and the closed form pricing formula. So a bond option, as you can imagine, is an option on a bond. Again, it gives you the right, but not the obligation to buy a bond at a specified price when the bond option expires. This is, of course, the European style option. American style options would allow you to buy the bond at any time before the expiry date. But for our purpose, we will focus on European options, which is also more widely used, for example, in the context of hedging. All right, then after that, I would like to tell you about the calibration of the Vasey check model to government bonds and bond options. That means I will tell you how the parameters of this model can be determined from the market quotation of the prices of government bonds and the bond options. Okay, so firstly, let's talk about the principle of risk-neutral pricing. I think, in my opinion, the most important result from risk-neutral pricing is that a future payment, say at time called up, which is uppercase T here, the fair price or no arbitrage price of this future payment at the present time, let's call it the lowercase t, is given by the expectation here. Here's the xt is a payoff at the future time. Ft is the information available about this contract, let's say the bond or whatever that we want to price up to the time of pricing. And the integral that appears in the exponential function, which is Rs here, is as interest rate. So Rs is a interest rate at time S, and we see that we have to integrate the interest rate from the time of pricing to the time of payment. The reason that we have this exponential term here is that the payment is made in the future, and we know that something that is paid in the future is worth less than the same amount of the same payment made today, and therefore we have to discount this future payment. This pricing formula tells us that under the risk-neutral measure, which is called Q here, which is probability measure, the expected returns of the future payment is adjusted so that the discounted asset prices are martingales. So if a market is complete and there's no arbitrage in this market, then all asset prices, when discounted with the interest rate, are martingales. In other words, the market is fair to all participants, and there's no chance of making money without taking any risk on this market. Okay, so let's apply these methods to pricing bonds. But first of all, let me tell you a little bit more about bonds. So firstly, what exactly does this contract mean? So when we talk about bonds, firstly, there's we have to know its face value. For example, a government bonds, let's say a bond issued by the American federal government, which is usually called treasury bonds or treasury bills. The principal of the bonds, that is a face value, is usually, say, $100, which is what we shall call as face value F here. And this principal is repaid to the buyer of the bond at expiry date. Then there are the coupon payments that are made at the specified dates, which we call T1, T2, and so on up to time Tn. And Tn is the expiry date of the bond. So on each of these dates, the bondholder is paid an interest, and this interest is calculated as is called the coupon payments. this coupon payment is calculated as a percentage of the face value, and this percentage is called C. But usually this interest is annualized, whereas these coupon payments are not necessarily paid on an annual basis. Sometimes they paid quarterly, so every 3 months or semi-annually, and therefore you have to multiply CF with the fraction of the year from the previous coupon payment to the present coupon payment. All right, so these are the main ingredients of bonds. Well, the simplest form of bond is called a zero coupon bond. So that means it pays no coupon, it makes no coupon payments at all. All that you get paid is on the maturity date called T here. But of course, these bonds are sold at a discounted value. So for a face value of $100, you pay, let's say, only $70 at the time of purchase. So the interest payments are implicit. And for this reason, zero coupon bonds are also called discount bonds. So in this case, for zero coupon bond, its pricing is very simple. Applying the previous formula, all that remains of this bond is the discount factor. And when the interest rate is deterministic, it is simply the exponential function discounted by interest rate times the time from the pricing date to the expiry date or maturity date of the bond. If, however, a bond does make coupon payments, that, or in financial terms, they say this bond has a cash flow, then you have to discount each of these coupon payments as well as a final payment, which consists of the face value of the bond and the final coupon payment made on the same day. You discount these payments, or otherwise called cash flows, and sum up the discounted value, and that gives you the price of the bond. So if we look at these formulas, we see that if the interest rate is deterministic, then at any given time before the expiry date, the bond price is deterministic. But of course, this is not what we see on the financial market. So this is exactly why we need an interest rate model and think of the interest rate as a stochastic process. Okay, so that takes us to our next topic, stochastic interest rate models. So a large class of interest rate models used in finance models interest rate as a diffusion process. That means both the drift coefficient and the volatility are functions only of the interest rate itself. So by the drift coefficient, I mean the mu of RT here, which is a coefficient to the term dt, and the diffusion coefficient is called the sigma of RT, which is in the world of finance usually called the volatility. So for a coupon bond, its price can be calculated as cash flows discounted using the price of the zero coupon bond, which is just a discount factor. And when the interest rate is stochastic, the discount factors are stochastic as well. And we will see that because of the discount factor, the volatility of the interest rate will also affect the bond price, and indeed the volatility itself may be a stochastic process. Okay, so let's look at some concrete stochastic interest rate models in the next few minutes. So the simplest model that has been used to model interest rate is a so-called Xie model, which is Ornstein-Uhlenbeck process, which is a mean reversion process. It has three parameters. Here, A is the speed of mean reversion. It tells us how quickly the interest rate will revert to its long-term mean, which is denoted as B here. And sigma is simply a constant. It tells us the volatility of the interest rate. And this stochastic differential equation is fairly easy to solve. And by solving this SDE, we will see that the expected value of the future interest rate can be expressed as the long-term rate plus the difference between the present rate and the long-term rate discounted by this exponential factor. And it's also the same goes for the variance of the future interest rate. We have an explicit formula for the variance as well. Okay, now let's see how we can use a Xie model to price a bond. So, well, it has been worked out that when we use a Xie model, the price of a zero coupon bond can be expressed in this form shown here. Notice that if we take the logarithm of this bond price, it is a linear function with respect to the interest rate of RT. And we can easily work out the two terms of AT and BT that appear in this pricing formula. And according to this Xie model, we can also calculate the yield of the zero coupon bond. That is, for every unit of currency that we invest in the bond, how much we are going to make as a percentage. All right. So we see that with the Xie model, it somehow lacks flexibility. The long-term mean is simply just a constant, and people have quickly found out that when they calibrate this model to financial data, its model doesn't exactly fit. So Hao and White have extended this the Xie model. And the main modification to it is to allow the long-term mean of the interest rate to fluctuate with time. So what happens in practice is that people will look at a set of government bonds on any given date. So they will figure out this deterministic function theta t, which gives the level of mean reversion. But of course, this function changes from one day to another, and therefore you have to determine the model parameters every day and find out the value of theta t from some market value, from some market quotations. And indeed, the form of the theta t can be well, expressed in terms of the instantaneous forward rate that is quoted on the market. So the instantaneous forward rate on the market is, you can find that out by looking at the price of a zero coupon bond that expires at time t, and look at this price at the present day. And you, well, because the price of the zero coupon bond is effectively a discounting factor, then you can infer the interest rate embedded in the price of the zero coupon bond, and that gives us this instantaneous forward rate. Okay, so yeah, once we have figured out this theta function, we can express the terms of A and B, and we will find out the price of a zero coupon bond according to the Howard model. All right, so now let's look at the European bond options. So as we said before, this option gives the holder the right, but not the obligation to buy a bond, 1 unit of the underlying bond at the expiry date. So therefore, its price at the time of expiry is a difference between the market bond price and the price agreed upon, which is called the strike price, and denoted K here. So if the market price of the bond is higher than the agreed price, then the price of the option is the difference between the two. If, however, the price of the bond is actually lower than the strike price, then the holder will simply can't do much. The option is useless. The holder will simply let it expire, and therefore its price is zero. So with we can, and therefore we use the same pricing formula and can find out that the price of the option at a time before its expiry can again be expressed in this as this expected value in the risk neutral measure. We can, if you just carry out the calculation straightforwardly, we will see that the price of the option is fairly similar to that of Black-Scholes. Here, sigma p is a volatility that we talked about earlier. All right, so the next question is naturally how we can find out some parameters of these models using market data. So usually the model parameters are determined by using a minimization procedure, and the objective function here is to minimize the difference between the bond price calculated according to the model and the market price of the same bond. And we shall also take into account as well the difference between the model price of the bond options and the market price of the same bond options. So that is the idea behind the objective function. And there are a lot of minimization software available, including those that are open source, such as a new scientific library that we can use to do the minimization work. All right, so if applies more specifically this to Vasicek model, we will see that for the Vasicek model, in addition to the 3 model parameters, we also have to figure out the instantaneous interest rate at the time of pricing, which is R0 here. We know that the interest rate are not exactly observed, and therefore we have to infer it. So it forms part of the model. I mean, therefore it becomes one of those numbers that we have to figure out by calibration. But of course, sometimes we don't really have a zero coupon bonds on the market for a particular currency. For US dollars, you have a lot of them, but for example, for Chinese yuan or British pound, there are only a limited number of zero coupon bonds, and therefore we have to calibrate the interest rate model to to government bonds that makes coupon payments. The reason that we prefer zero coupon bonds is that, as we see earlier, they are much more sensitive to the fluctuation of the interest rates than our coupon bonds. Therefore, they are more preferred. But in case we don't have enough zero coupon bonds, then we have to use other instruments. Right. So, I should also tell you about why we want to use government bonds and not bonds that are issued by, for example, companies. The reason is here we're talking about the interest rate is a risk neutral measure, and therefore we really want to exclude the impact of the possibility of the issuer of the bond being unable to make the coupon payments or even repay your the initial investment. And the government, well, for most governments don't have that issue. For example, if you buy American bonds and the American federal governments can simply print money, right? So there's zero chance that they will refuse to make that payment if they don't have enough money to, well, make the coupon payments. They simply print. But for a company, it may have debt, and therefore the possibility of the company being able to fulfill its financial obligations is much higher. And therefore, when we calibrate an interest rate model to the market prices of bonds and bond options, we want to use government bonds. Okay, right. Okay. Yeah. So for the Vasi-Check model, let's look at. Sorry. There's a few, we need to bear in mind a few things, and more specifically, what these different values will affect the outcome of the calibration. So R0, as we said, is the current, the level of the interest rate at the time of pricing, and therefore it anchors the model to the front end of the yield curve, meaning the yield, or otherwise the implied interest rate. The interest rate implied by bonds that will expire very soon. And here B, the long-term mean, will affect the prices of of bonds that expire long into the future. Yeah, so that means the value of B will be more dependent on the prices of bonds that expire long into the future. And A here, it controls the curvature of the yield curve. But here by yield curve, we mean we make a plot of the yield of those bonds as a function of its time to expiry. Since the curvature of this curve will be very much dependent on the value of A. And this mean reversion rate will determine how fast short-term shock to the interest rate will decay. Okay, and the sigma, here's volatility, of course, is more impactful to those bonds, to the prices of bonds that expire later in the future. But of course, we note that Vasi-Check model has a small fixed, has a small number of parameters, and these parameter values are constants, and therefore we can't really expect it to fit the yield curve exactly. And the difference between our model prices and the market prices are genuine curve fitting errors.
We have 1 minute left.
Yeah. Okay. All right. Here I'm just listing the formulas of bond pricing, which we have, which is an application of the previous formulas we have looked at. Okay. All right. So basically that's all.
Okay.
Yeah.
Dr. Xie, thank you for the presentation.